Good morning, everybody. Welcome to the morning meeting of the virtual hedge fund experience we call ARMR Investing. I'm going to share with you big picture macro, talk about the risk monitor and what may change this week. Some top stocks to watch, some of the stocks we're going to buy in here, some of the stocks we're going to trade in here. We're going to go over all that, talk about our day trade from yesterday on the S&P and what we're looking for with the open this morning. So lot to get to. Let's dive right in. Don't forget, you're the portfolio manager of your own assets. You're part of a virtual hedge fund, and you're in this conference room. So take the information, make it your own, figure out your risk tolerance, your goal, and then execute a strategy with ruthless precision. Be the smart money on your own. You can be the smart money. Okay. So diving in, what I would say first is the battle lines are drawn. And our job is not to predict what's going to happen next. Although I know that sounds like a crazy, notion, because everybody on CNBC and everybody you talk to loves to predict what's going to happen next in the market. And that's a complete waste of time. And there's no way to make money doing that. So what we want to do is read and react to what we're given. We want to have our strategy built before the directions revealed. And when we get that direction, we just execute it with ruthless precision. We don't think about it. We don't worry about it. We don't come up with all the reasons why it might not work. We just execute a strategy. And so on this desk, we use algorithms to help us do that, because human emotion gets in the way of those decisions all the time. You'll discover when you start using algorithms that whatever the algo tells you is almost exactly opposite what your human emotion wants to do. And that's how you know it's right. That's how you know it's right. So you execute the strategy and you accept the results. This is not about being 100% right. This is not about our ego. Oh, what if I'm wrong? It doesn't make a difference. I do this every day. I talk to all of you. If I can get over that, you certainly can, because nobody knows what you're doing. It's just you looking in the mirror. So be good to yourself. You put on a trade, it doesn't work, you take a loss, don't worry about it. You're executing a strategy. If the strategy is right, over time, you're going to make money. If you execute, if you let your emotion or your ego get in the way, you're lost. Okay? So risk monitor's red, but the battle lines are drawn, and it's equally possible that the risk monitor is green by the end of the week, as it is the market's plummeting and we remain in cash. So we have 5% plus cash in money markets. We're not forced to do anything. We're going to sit back and wait. And then we're going to execute this strategy on our desk. You figure out what you want to do. This is what we're going to do on our desk. When the risk monitor goes green, we're going to own the indexes first. And we're going to try to get on those trades and those indexes as close to the stop as possible. So we're going to use day trading tools to get ourselves into the big four indexes: S&P, Nasdaq, Dow, small cap. Once we have that allocation on, the rest of this week, I'm looking for this trade. If I can get day trades on those four indexes and they're profitable by the end of the day, I may hold them overnight. That's how close we are to a risk monitor green signal. I may hold them overnight using break even as my stop for a part of my portfolio. I have a day trading portfolio. I only day trade that. Right? Don't ever mix disciplines, right? That's day traded. It goes to cash at the end of the day. I don't care how much money I've made. That's great. I had a huge day, back to cash. But the investable part of my portfolio, there's two ways to do it. One, and the more conservative way, is to wait for the risk monitor to go green and execute that day. Nothing wrong with that, but you'll be paying up a little bit. Nothing wrong with that. Highest probability. You won't get caught in a bunch of whipsaws, right? Put the trade on when the probabilities are at their highest, rewards worth risk, live with the result. This is what I'll do with the majority of the assets I manage at Interactive Brokers, okay? So I'm an RIA, so I got a bunch of individuals I run money for, and that's what I'll be doing. Risk monitor goes green, capital to work in indexes first. Then once we've earned the right to take some more risk, in other words, over the next 5 days, if we're making money, we'll broaden out the portfolio a bit and buy some of our favorite individual stocks. That's the conservative way to put the money to work. If the risk monitor turns green and we hit the stop right away, the only money we'll lose is index, which is as conservative as you can get. There won't be slippage as we're trying to sell a whole bunch of stocks that aren't working, just the indexes. I'm going to use double or triple the indexes for that part of my portfolio. It's a swing trade. Probably double the S&P and the Nasdaq because they share so many stocks anyway. It's almost the same animal. And then maybe triple small caps and the Dow, giving me total coverage for those unique types of assets that I wouldn't buy normally. I'm not going to go buy small cap banks. I'm not going to go buy, Boeing, but I want exposure maybe to Boeing and Deere and Caterpillar. Boom, I get it that way in the Dow, have my allocation on, done. As that entry works, then I'll roll into some other ideas. So just take a quick peek here. This is the Nasdaq, and I know there's a lot of negative talk and everything, and we're risk monitor red. But at the end of the day, we're making a defense of the 50-day moving average and the uptrend that the market's been in since the start of the year. So until that's broken definitively on the downside, it's bullish. It's a nice, healthy pullback after a big run that sets up the next opportunity. And I know everyone's pointing to what looks like this horrible inside-out reversal day. I point to it too. It looks terrible. But it's also the pivotal day. And that's the battle line that's drawn. This is the pivotal battle line, that big down day. If the market closes above the high of that day, I'm fairly certain the risk monitor will turn green. If we close below the low of that day, the risk monitor will stay red, and I would expect the market to drop down to the 200-day. So we're in the midst of a battle where the buyers and sellers are going at it at the traditional 50-day moving average, that black line. Totally normal. No idea which way it's going to break. When it does, I'm going to execute. Here's the S&P. Same story. Here's the equally weighted S&P. That's down near the 200-day. Right on the uptrend. Nothing wrong with that picture. Nothing. Equally weighted Nasdaq. This often shakes out below the 50-day and then recaptures and takes off again. And let me just wrap up with this one thought of why I'm sharing with you a more bullish picture right now. Okay, I don't want to get too bearish. Risk monitor's red. I don't want to get too bearish. Okay, we're already in cash. Market craters. There's nothing for me to do. That's fine. We're in cash. We're bearish. Our alpha's going up because we're sitting in cash and we're day trading the S&P, extracting alpha every day. Okay, so what I want to say is when you have an uptrend that's that strong, it usually doesn't die an immediate death. It usually has that one more surge to test the highs. And then we'll know what we've got. It'll be a double top, rollover breakdown, or we'll make new highs. That's the highest probability of what I would expect the Nasdaq to do this year. So while I'm risk monitor red and max cash, I'm ready to put money back to work. All the algos are setting up. Could be this week, or the market could crater and we'll stay in cash. I don't know. So stay tuned. Keep working with me. I'll see you on the desk. Starts at 9:30. We're live streaming, so we can do it together. Okay? Here's the Dow. There's nothing wrong with that chart. I mean, there's nothing wrong with that chart. That's a major breakout of a pennant, pull back to test, recapture the 50. I'm going to want to be on it. Same with the small caps. Okay, so that's the picture from a risk monitor standpoint and why I'm still looking for the long trade while I sit in cash. All right, and I may try I might put on all 4 positions, and if they're up big by the end of the day, that'll be the beginning of a position for me in more aggressive portfolios. Okay. Now let's shift over to Treasury bonds. So this is the highlighted action of the day from yesterday's trade. Okay. This is the highlighted action for us. Whoops. See if I can get this to look right for us. All right, here we go. All right. We've been stalking the Treasury trade, TLT. It's down about 0.5% right now. Just give you a heads up there. We've been stalking this trade. Is the low of last year going to hold? We had the lock and load day a few days ago, and we're just about into the buy zone now. We didn't quite capture the zone yet, but I like to say that there's, I like the 4th day after a lock and load bar. So this was the gap up, which I call the lock and load. I don't buy that day. I want to see how it trades. It's been a tight consolidation for 3 days. This is day 4. I want to see it break out. If it takes out the low of yesterday, I'll be out of treasuries. And I'll be looking for it to make a double bottom, and I'll try it again. And we'll see if this low from last year is actually going to hold. All right. But if we get into that green box, that's the buy box. And we closed just below it. And I put a trade on a little bit ahead of it. And, I guess I'm regretting it a tad because it's down 0.5%. I could have bought it a little bit cheaper this morning, but I did it right at the end of the day yesterday, as it was right in the zone. This is a 3-minute bar chart now. So the first chart you're looking at over here is daily, and this is 3 minutes. So this is the intraday trading. So I picked it off right off the low here. This was a reversal yesterday in the stock. That reversal I used to put a position on treasuries. So it ran up into the end of the day, and I held it overnight because I got a bit of a cushion, and it's going to give that back this morning. It's coming in right around in here. Okay, so we'll see how it does. If it gives it away today, I won't hold that overnight. But if it holds in here and gets into that green box, we're going to have a nice setup to be long treasuries. And of course, long treasuries, long treasury bonds means that interest rates are coming down. So now let's roll over to these charts that I just find amazing. This is AT&T and Verizon. Now, I mean, am I crazy to look at these stocks? I mean, everyone tells me they're going out of business. Really, the cell phone companies, the companies that give us internet access, the companies we use every day, they're going to go out of business, right? Amazon's going to come in and take over, making their own cell networks. I don't buy it, okay? I don't buy it, but I don't own it. I haven't bought it. I don't own these stocks. But when I see symmetry like this, it forces my eye to look at it. We're looking at 8% yields right now on AT&T and Verizon. And I submit to you, if treasuries go up in here and the long bond rates have peaked, then an 8% yield on AT&T and Verizon just doesn't make any sense. So for a dividend investor, I may be buying these things. And these look like classic bottoming wedges, complete with the shakeout, total capitulation implosion on AT&T and Verizon, and absolute identical chart patterns now. That looks too perfect to me. And if I zoom out, if I zoom out, you can see that they shook out below last year's low. So while treasury yields are trying to hold last year's low, AT&T and Verizon have had the capitulation throw up of the guys who own it. They've just all puked it out. And there's a possible reversal. Possible. Terrible relative strength. Everybody hates it. I get it. But an 8% yield, if interest rates on the long bond come down, I gotta assume all the bad news is priced in here. And of course, you use the bottom of that wedge as your stop. So it's always a reward to risk setup. Put the trade on, for me. I'll put the trade on if I get to that point. and hey, it takes out this capitulation low, and obviously I'm wrong. Got to get out, take my loss. But if I get it right and it breaks out of this bottoming wedge, we could be on a stocks that go a lot higher and lock in a close to 8% yield. So, couple of stocks to watch right there at the top of my list. Then let's scroll over to round out this conversation. Well, before I do, I'm going to dive right into the S&P trade. Don't forget, we smart trade the S&P every day. So we don't day trade it, but we smart trade it. If we get a setup, we hit it. Okay. And the setup yesterday that really works, for us was right in here. So for those of you at home who are trying to follow along with the day trading playbook, there's 5 entries. There's 5 entries that we use, 5 buy triggers. And what you see right here are 2 of them stacked on top of each other. And this was the trade yesterday. So market sells off for over an hour and then recaptures the first standard deviation below the VWAP. That's what the black dots are. So don't forget, this is an algorithm called the price movement profiler. That's what we call it, the PMP. VWAP is at the center of it. Fibonacci extensions above and below, and average true range highs and lows. Okay. So I wanted to share this with you because there's what we try to trade. When we have sell off for over an hour and we recapture the first standard deviation below the VWAP, the white bars lock and load. And if you take out the high of that, that's the buy trigger. You get long. It did it twice in close succession. So one was the standard deviation. Then it went above the VWAP and it extended to the highs of the day. Profits could be booked at the high of the day. You raise your stop to the low of the bar that hits that high, and you get stopped out booking a nice profit on the morning. And really, it was just a washing machine day, and there was one trade there that set up for us. That late trade in the afternoon is not a trade for us. We already made our money earlier in the session. All right. Now let's round out this conversation with maybe the top 3 the top 3 stocks that will be on my desk. What are the stocks I'm watching? What are the stocks I might buy? If the risk monitor were to go green, these 3 stocks would probably be the first 3 stocks I'd buy. After buying the indexes, right? And then bang, these 3 stocks. Let's don't make it harder than it is. We don't have to outthink everybody. You could do that with some of your portfolio, but you don't have to make it that hard. Right? These are the 3 stocks that I like. All right. NVIDIA. Blowout earnings, moved higher, gave a lock and load and buy trigger ahead of earnings, which I wasn't willing to buy it in front of earnings. Gapped up, gave away the gap, still trading above the low of the buy day. So it can be owned with a fairly tight stop. I'm just talking about technical analysis, buy triggers, swing trades. Don't talk to me about PE ratios and fundamentals and all that stuff. That's not what this is about. This is about 7 stocks that have been carrying the market all year. Just 7 stocks. And these are the 3 that are in buy zones right now. That's all I'm saying. If the market continues to make new highs, these 7 names are going to keep driving the market. So these are the 3 that I would buy first. NVIDIA, Google. Google is in a lock and load state. And if it took out the high of the reversal day, that would be the buy trigger. Okay. And the one I want to focus on today is Tesla. Okay. We bought Tesla down here. We sold it right up here at the top of this red downtrending channel. Okay. We just kept raising our stop until we got stopped out, which I think was on that down day right there. Okay. So it's pulled right back and made a perfect 3-bar reversal at the 200-day moving average, the exponential 200-day, which is green. The gray line is the standard 200-day, the exponential 200-day. Perfect 3-bar reversal, candlestick charts. Go look it up, read about it. Pretty simple, right? Break below the key location, gap back above it. And it's in the buy zone, which is the green boxes, the green box. It's in the buy zone. Closes above the 50-day moving average, that would be the last day you could run after it. I mean, that would be it. You wouldn't chase it after that. The stop would be the low of the buy zone. And you could pull that down to there. That would be the stop, the low of the buy zone. So the risk is worth the reward. And the reward, and I just wrote for you in the captain's note a interesting piece about the difference. You know, Tesla just turned on their generative AI supercomputer that they've made on their own, Dojo, right? So the way to understand it is they're about to turn on this super stack that they've built with NVIDIA chips. But NVIDIA chips, this is an interesting piece that I read. It helps understand. So they've just turned on 2 major super stacks of generative AI to help them with their FSR, right? Which is like the future of, I guess, driving, I guess. I don't know. But in order to get to that future, they need these unbelievable stacks. And the way to understand it is the NVIDIA stack they're using, this super, computer generative AI stack, is like Apple using Intel chips for their cell phones, right? And then in-house, Apple developed their own chips for their own iPhone, which is geared towards what they're trying to do. And that's what the super stack is that called Dojo that they just turned on yesterday. And what it reminds me about, sometimes we all might get lost. I get lost in this. You think of Tesla as a car company. It's not a car company. It's just not a car company. It's not an auto stock. You can't compare. Oh, people look at the auto numbers and the sales. That's really not what this company is. This is a John Galt company. This is a company run by a guy like John Galt. Okay. And while there's risk to that because he's, unconventional, there's also significant reward that he's really building something unique. And so do I want to be involved with him? Do I want to partner with him? I probably do. I probably do. And so I try to put on risk reward entry points. Breaks below the low of the green box, I get out. Takes off from here, I'm going to want to be long Tesla. So those 3 stocks are the top stocks to watch for me, possibly stocks to buy for me if the risk monitor is turning green. And then everything else follows after that. So I hope you found that helpful. I look forward to working with all of you. 9:30, we'll get the day started. We'll look for our day trade on the S&P, but I'm also going to be looking for day trades on all of the indexes and get on them. If we make money on those trades, I might turn them into swing trades as I preempt a little bit what I think is going to be a risk monitor green signal. Now, I'm just doing that for aggressive portfolios. As I said, everybody else, I'm going to be patient, wait, get risk monitor green. I'd like to see a Friday close that proves the risk monitor. That would be ideal. So, we don't always get ideal. It could be a Wednesday. It could be a Thursday type of risk monitor green, and I'll take it. I'll put the trades on. Low of the day is the stop. My last thought to you is, if you're day trading, the number one most important aspect of day trading is getting your stops right. And the tighter the stop, the better. If your buy trigger's right, the stop will never be challenged. Tight stops extract fear. There's no fear in trading if your stop is 10 cents on a $100 stock. Well, 10 cents is nothing. If the reward's $1 and your stop is 10 cents, you're going to make a lot of money. Ego gets in the way of that thought. Oh, I don't want to lose money. It goes down 10 cents. What if it goes back up on me? But you got to get rid of all those thoughts. And I'll do it with you live on the desk at 9:30. I can't wait to start the day, guys. Have a great session, everybody.